If you're wondering whether now is the right time to start investing, this video will walk you through 5 major reasons why you should start your investment journey now. And more importantly, I'll reveal the top assets the rich are using to grow their money in 2026, so you can position yourself on the right side of wealth. The number one reason you should start your investment journey now is that the U.S. Supreme Court has just ruled against President Trump's tariffs. Let me explain. On February 20th, 2026, the Supreme Court ruled that many of Trump's sweeping tariffs on imports from countries like China and other nations were illegal because the president overstepped his authority under U.S. law. Now, you might be wondering, why does that matter to me as an investor? Here is why. Tariffs increase costs for businesses because when companies pay more for imported goods and materials, their profit margins shrink. But now that these tariffs are about to be removed, those costs will drop. And when costs drop, profits improve. And when profits improve, stock prices tend to follow, which restores something the market desperately needs: stability and predictability. For instance, think back to 2025 for a moment. What happened when tariffs created uncertainty? We saw massive market sell-offs throughout the year. One of the worst moments was the October crash that wiped out billions across both the stock and crypto markets in a single day. That volatility was fueled by trade fears and economic instability. Now ask yourself, what happens when that pressure is removed? The tide will likely begin to turn. The number 2 reason is that interest rate cuts are coming. The second reason you should start investing now is that interest rate cuts may be coming sooner than many people expect. And when rates fall, money starts moving. Here's what's happening. A new Federal Reserve chairman is expected to take over in May, and President Trump has consistently advocated for lower interest rates and a weaker dollar, arguing that both would help the U.S. economy grow faster by boosting exports, increasing liquidity, and stimulating business expansion. Now, with a new Federal Reserve chairman who is his pick stepping into leadership, the market is anticipating a shift in monetary policy. So, what does that mean for you? Lower interest rates make borrowing cheaper, and when borrowing becomes cheaper, businesses take more loans to expand, companies invest more in growth and innovation, and consumers borrow more to spend. And when borrowing and spending increase, more money flows through the economy. For example, think of interest rates like a faucet. When rates are high, the faucet is tight. Money flows slowly. When rates are cut, the faucet opens. Liquidity increases. And where does that money go? It flows into assets. Historically, lower interest rates tend to push investors towards stocks, real estate, growth companies, and even speculative assets like crypto. Why? Because when savings accounts and bonds offer lower returns, investors start looking elsewhere for higher yields. That means more money in circulation, more investment activity, and more upward pressure on asset prices. Now ask yourself this question. Do you want to start investing before that liquidity wave hits the market, or after prices have already adjusted? Remember this. Markets don't wait for headlines to become obvious. They move in anticipation. If rate cuts begin in the coming months, the biggest gains often happen early, when smart money positions itself ahead of the shift. This is why interest rate cycles matter, and this is why now is a strategic time to start investing, before cheaper money fuels the next phase of market rally. The number 3 reason is the stable global economy. The third reason you should start investing now is that the global economy is becoming more stable, and markets love stability. For instance, the 12-day war between Iran and Israel in 2025 triggered massive sell-offs across the stocks and crypto markets because war creates uncertainty and investors pull money out of risk assets when there are rumors of war. But as tensions in the Middle East begin to ease and diplomatic efforts strengthen, confidence is slowly returning to global markets. And confidence is powerful because when investors feel safer about global economic stability, capital flows back into markets, which creates a friendly environment for investment growth. The lesson to learn here is this. Markets react strongly to uncertainty, but they also recover strongly when stability returns. Another example of how uncertainty can trigger a massive sell-off was the gold and silver crash of January 2026, driven by uncertainty over the appointment of a new Federal Reserve chairman. The fourth reason is that the stock market has been on a bull run over the past year. Even with geopolitical tensions, tariff uncertainty, and global economic fears, the stock market has pushed higher over the past several months. And that reveals something important. Investors are still confident in the market's growth. Here's the proof. In December 2025, the S&P 500 hit an all-time high, showing that America's biggest companies are still trending upward despite economic challenges. And in the world of tech, NVIDIA, a key driver of AI and innovation, surpassed a $5 trillion market cap last year. That's a massive milestone and a sign that major players are still leading growth and investment flows. And when the largest tech stocks break records like this, it's not random, it's momentum. And momentum matters in markets. Why? Because strong market performance builds confidence. When investors see prices moving up, more capital flows into stocks. More buying pressure pushes prices higher. Companies feel more confident issuing shares and expanding. And more investors choose to enter the market rather than stay on the sidelines. In essence, you could say it's a cycle, but it's one that favors those already positioned in the market. Now think about this. If the S&P 500 is rallying through uncertainty, what could happen once geopolitical risks fade and interest rates begin to fall? History has shown over and over again that bull runs don't stop suddenly. They speed up when confidence expands. That's why the current momentum, strong rallies, new highs, tech leaders breaking records, is another reason to consider starting your investment journey now. The fifth reason is the surging demand for precious metals. Gold has surged above $5,000 per ounce after dipping in January, triggered by the massive accumulation by central banks around the world. And this isn't random. When gold and silver prices hit record highs, it often signals two things. Investors are actively reallocating capital. Big money is positioning for the next phase of economic movement. In essence, precious metals don't surge quietly. They move when capital is shifting globally. And here's the bigger picture. When you see the stock markets rallying, interest rate cuts expected, geopolitical tensions easing, and gold hitting record highs, it tells you one thing: money is moving. Smart investors don't wait until every headline is positive. They position themselves while trends are forming and invest at the right time. Now that you understand why now is the best time to start your investment journey, let's see the assets the rich are accumulating in 2026 and where smart money is going. The number one asset the rich are accumulating is precious metals, gold and silver. With gold trading at record highs and silver gaining momentum, wealthy investors are increasing their exposure to precious metals because gold and silver act as a hedge against inflation, currency weakness, and economic uncertainty. When paper currencies fluctuate, precious metals tend to hold value. That's why central banks are buying more gold, and smart investors are doing the same. Remember this: smart investors don't invest all their capital in gold, but they use it as protection. The number two asset is real estate. Real estate has proven itself over time as one of the most reliable ways to build generational wealth. That's because it gives you multiple advantages at once. You can earn cash flow from rent. Your property can grow in value over the long term. You can use it as leverage, meaning you borrow money against your asset to invest in other assets. And on top of that, there are tax advantages that help you keep more of what you make. If you have been following the market, you will notice that even when the market goes through ups and downs, real estate has historically rewarded patient investors. And when interest rates fall, property activity usually picks up again. The rich understand that land and housing will always be needed, so as long as people need a place to live, real estate will always matter. The number two asset the rich are investing in 2026 is index funds and ETFs. Remember this: not all investors are chasing risky assets. Many grow their wealth steadily through S&P 500 index funds, broad market ETFs, low-cost diversified funds. Why? Because over time the market trends upward, So instead of trying to beat the market, they own the market. In essence, they're not worrying about charts, daily price swings, or short-term headlines. They're not trying to time every dip or chase every rally. They simply stay invested, stay consistent, and let compounding do the heavy lifting. It might be boring, but over the long run, it's incredibly powerful. The amazing thing about this approach is that it's low-cost, well-diversified, and generally carries less risk than picking individual stocks. Now let's talk about the number 3 asset, AI stocks. If you have been following the market, you will notice that artificial intelligence is attracting massive capital inflow right now. And the wealthy are already positioning themselves. They're investing in semiconductor companies, AI infrastructure providers, cloud computing firms, and automation and robotics companies. In essence, they are positioning themselves across the entire AI ecosystem. Why? Because AI isn't just some short-term hype cycle. It's reshaping entire industries, from healthcare to finance to manufacturing. And here's the key thing you need to understand. Smart money isn't just chasing headlines. They're not just buying hype. They're investing in the companies building the tools, the chips, the servers, the systems, the foundation behind the AI revolution. That's where long-term value is created. The number 5 asset the rich are investing in 2026 is cryptocurrency. While the crypto market continues to dip, the wealthy are still investing in speculative assets like crypto. But here's the difference. They do it strategically. They allocate a small percentage of their portfolio to Bitcoin and Ethereum because they know that crypto is volatile, it's high risk, but it also offers high upside. The key word here is allocation, not gambling. They don't bet everything. They position wisely because they know crypto can offer quick returns when market sentiment shifts, liquidity flows back in, and momentum builds. But they also understand that it can crash fast, like the October 2025 market crash. That's why it's a calculated position, not an emotional decision. Now, from the assets we have mentioned above, you will notice that the rich don't put all their eggs in one basket. They diversify. They protect themselves with gold and build long-term wealth with real estate. They grow steadily with index funds and position for innovation with AI stocks. And they take calculated risks with crypto. This is how real wealth is built, not by chasing one hot trend, but by combining stability, growth, innovation, and smart risk management. Now the real question is, will you position yourself the same way? Because if you don't start investing now, you might look back at this moment and realize, this was the best time to start investing in 2026. Remember, this video is not financial advice. It is only for educational purposes. Investing is risky and can wipe out your portfolio if you don't know what you are doing. Always do your own research before investing. And do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.